Today we're talking about how paying off debt can help get you more debt, oddly enough. My name's Evan Kaufman, Airview loan originator. So one way to get a larger mortgage or to be approved for a larger balance is to actually pay off some of your current debts. And in this video, we're going to talk about why that is, and at the end go over a real example of how impactful it can actually be. So why is it that if I actually pay off some debts, I can all of a sudden be approved for more debts? Well, it comes back to when you're getting approved for a mortgage, looking at your debt to income ratio. Because as lenders, this is one of the primary indicators we're looking at to see, do you qualify or not for a home loan? Now, for example, if we're looking at conventional loans and most loan types, you usually need that debt to income ratio. It's based on a percentage at 50% or less. For VA loans, it can be a little more nuanced than that. It can go a lot higher. Sometimes it's restricted because it's based on something called residual, but we still need to make sure that DTI makes sense in general. The debt to income ratio is calculated by taking your total monthly liabilities and dividing that number by your total monthly income. And that gets us a percentage. What do you actually mean by that? Well, those monthly liabilities are going to be those major things that you have installment loans on or revolving credit lines. For example, student loans, car payments. If you have a credit card balance that you're actually making minimum payments on, that will count within that as well. Things like utilities, rent, phone bills and stuff, those typically are not going to be included in that section. But the main thing is like when we run credit or check credit, when we see those installment loans, car loans, student loans, etc., those count in this upfront debt number. Any other mortgages that you might have, those count in that upfront debt number. So what we do is we take those and add them all up and then divide it by your gross, meaning pre-tax monthly income to get us our number. Now I mentioned at the beginning and give you a real example of how impactful this can be. Let's say right now you're getting denied for your mortgage for some reason. You're like, hey, they say my debt to income's too high and I don't know what to do. They said pay stuff off. Well, here's how it's really impactful. Let's say you make $5,000 a month in gross income and you have $2,000 a month in a car payment and maybe some credit cards or whatnot. And you're trying to go apply for a mortgage that's $2,000 a month. And that's a very realistic scenario that we see here sometimes. So if you all of a sudden are going to keep the credit cards and the car payments, and that's $2,000 a month. And you're going to now all of a sudden take out this new mortgage payment that's $2,000 a month. That means your gross monthly expenses are going to be $4,000 per month. And you have a $5,000 a month income. So all of a sudden, your debt to income ratio before the mortgage was just $2,000 a month divided by the $5,000. That's a 40% debt to income ratio. But if you have your mortgage payment on top of the debts, all of a sudden you're at an 80% debt to income ratio because you have $4,000 a month of payments, only $5,000 a month of income, divide 4 by 5, you get 80%. Here's the power of where it makes a big impact when you can pay off debts. Let's say you had the money to pay off that $2,000 in credit cards in your car. Well, all of a sudden your debt to income ratio went down from 80% back to 40%, and there's a good chance you're going to be approved for a mortgage so long as all your other factors check out. That's how impactful it can really be. Now, those are really easy, bigger numbers to take I say realistic, but also quasi not, because it's just so large. So let's look at another one here to give you a good idea, which is what we will see oftentimes, is let's say, again, you have $5,000 a month income, and you maybe have $1,500 split between two $500 car payments and then another $500 that's going towards credit debt or whatnot. We look then at all of a sudden, there's $1,500. You have $5,000 a month. You're at a 30% DTI, assuming no mortgage on top of that. If you're wanting to all of a sudden take out a mortgage that is, let's say, $2,000 a month, now all of a sudden that 30% DTI is bumped up to a 70% DTI. Now we look at those debts and we go, do we need to pay them all off? Or could we maybe get away with paying off a portion of those debts? So let's say we know, okay, one car balance is too big. We can't quite knock that out. We don't have the funds to do it. But we can knock out maybe one of the smaller car loan balances and we can get rid of the credit card debt. Now all of a sudden we have that $500 left on the one car, but you paid off $1,000 a month for payments and the other debt. And now all of a sudden we're going and looking at $2,000 mortgage. We're at a 50% DTI roughly, and there's a decent chance it's going to clear. Now, would I still advise a 50% debt to income ratio on a mortgage? No. You watch some other videos for us on that. We ideally want to see yourself at around 35% or even lower. Obviously, lower is always better. 35% or less is kind of your ideal target for it. But if you see income growth or you're keeping, say, your spouse or someone that you're with off the mortgage application entirely, you know there's a lot of other income, you can know that, hey, there's a decent chance that a mortgage application might just clear from around that 50% DTI mark, so long as all my other factors are okay. But that's the power of how paying off debts can oddly help you get, I say, more debt in the beginning, but really afford that home that you might be wanting. So very common scenarios we see are exactly what we just talked through there, where, hey, I might need to knock off and pay off that debt that's $300, $500 a month, because paying that off lowers my debt to income ratio by 10, 15%, which allows me then to go get at a home at maybe it's another $50,000, $100,000 more in home value. And that's something I can actually get in this area that I want to live in. So there's the power of being able to pay off debt to help yourself go buy something else, or I say get into more debt, but get another asset, get another home that might be a little bit more affordable where you want to be. So my name's Evan Coppin again. That's how you work debt payments to help improve your debt to income ratio to go get a home.